More on the markets on the penultimate trading day of the year. Joining us is Kathryn Rooney, Vera, Bulltick Capital Markets Head of Research. Kathryn, good to catch up with you. Now, big debate going into next year. Hard landing in the economy, soft landing. Has the market already had the bear market that we should expect around a recession? You're pretty confident that we will, in fact, get a formal recession next year?
Well, Mike, if the Fed is serious about its 2% target, which apparently it has become, then, yeah, I think recession is inevitable. One of the primary drivers is the demand side. So salary growth of 5.5%, 6% is not commensurate with 2% inflation. The Fed realizes this. And the unemployment rate at 3.7% is not close to what we estimate the NAIRU, the non-accelerated inflation rate of unemployment, which is the neutral rate. Below that rate, which we think is about 4.9%, the labor market remains inflationary. So the Fed has to force, as your previous guest said, rates higher. The unemployment rate will likely follow suit. Consumer confidence drops as a result. The consumer, as you know, Mike, has been remarkably resilient. And that's primarily because they still have jobs, right? Everyone has a job. Salaries, maybe they're not equal to inflation, but they're rising. That makes you feel good. And if you have a job and you don't like it, you can find another one. So that's kept consumer confidence pretty resilient and consumption strong. When we do get that turnover in the labor market, however, that's when I think the equities are going to take a further leg lower. And the economy does roll over into recession. The good news, of course, is that brings inflation down. I have inflation ending next year close to about 3.5%.
So one difference now versus a year ago, in addition to valuations, in addition to the fact that the Fed was just going to be starting tightening, last year, is that bonds now offer a little bit of yield. There was no cushion in bonds a year ago. Is that an attractive area, or is that a little bit of a trap?
I think it's the most attractive area right now. I think going into 2023 and the unknown of when the recession will hit, I think it's generally consensus that there will be a contraction in domestic demand, private investment, and consumption. But when that happens, I think keeps me more on the cash and cash equivalent sidelines. You can get T-bills, Mike, 3 months, 6 months, commercial paper, 4.5% to 5%, investment grade paper. That's pretty attractive for the foreseeable months. Going into later in 2023, as the Fed reacts to a higher unemployment rate, dropping inflation, then we can add duration. Then we can look for more risky assets. But for the near term, I like short-term paper, I like investment grade, and I like cash and cash equivalents.
And within equities, so would that suggest that you would prefer to just sort of stay defensive, which is essentially, what has done relatively well this year?
Yes. Yeah, and that was my call coming into this year, and it's done very well. In stagflationary and recessionary periods, generally the sectors that have done well, relatively speaking, year to date in 2022 are those that we should stay overweight into 23. Those are, of course, energy, utility, staples, and healthcare. So I still like them. I think we should have overweights there. Start to accumulate fixed income. I think fixed income the famous TINA is no longer. So we do have alternatives, and thank goodness for that, Mike.
Yes, unlike a year ago, perhaps there are some relatively safe alternatives. Kathryn, thank you very much. Appreciate it.
My pleasure.